Okay, a buddy of mine named John Pope, I've mentioned him in the past, he brought up this hedge strategy to me about this VIX hedge strategy done by Option Alpha. And the guy's name is Kirk. He's been around for quite a while. And he talks about this hedge strategy that I got into. Let's take a look at this video. This is all public information.
Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the nightly video update.
So what I'm going to do is I'm going to go through this VIX hedging strategy, and my takeaway on this particular strategy, he goes over how it works and everything, so I'll go over that also. I might do some back tests, but just the point here is let's take a look at this hedge that Kirk looks like he developed here. In this video, I'm going to go over 3 separate hedge strategies. A hedge is a position in a portfolio that is designed to protect that portfolio in case the market drops. The first 2 hedges were designed and are traded by Kirk Duplessis of Option Alpha. Option Alpha is a well-established options trading educational company established back in 2008, I believe. Now, Kirk has recently shared the hedge strategy that he uses in his portfolio in a public video called Vix Hedge Strategy Review, and I'll leave a link in the description below of that video. The purpose of his hedge strategy is to be proactive. This means the hedge should always be on and ready in your portfolio before the market crash occurs. He wants to hedge his portfolio that is mainly made up of sold option premium. Again, this hedge is designed to always be on as opposed to an opportunistic style hedge. If you try to put it on too late after the crash has already started, it's really too late to be effective. It's a proactive hedge, not a reactive hedge. When evaluating this type of trade, I have composed a few questions that I want to answer. Number 1, how much protection do you get? 2, how much does it cost? 3, what are the risks of the trade itself? 4, what are the margin requirements? 5, are there any setup or execution drawbacks? And 6, what are the time requirements? So how much protection will I get? Now this question is something to find out during backtesting. After the amount of protection is calculated in a market crash, then all the other variables such as cost, risk, margin requirements, planned capital, all that stuff can be calculated on a percentage basis. So when evaluating hedges, I like to know what the cost is in relation to the protection I'm getting. Will it cost 3% a year, 5% a year? The cost of the hedge actually steals away from your portfolio returns in exchange for protection. Now, what are the risks? I like to look at the worst case scenarios in order to measure risk, and this needs to be taken into consideration when planning out the capital allocation and risk reward. The risk may be so high that the reward is not worth the risk. Now, what are the margin requirements? Typically, it can be a good idea to use portfolio or span margin as long as you can figure out what the maximum margin expansion could be or what that was in the past. And this will help with planned capital allocation per tranche. And when I say per tranche, I like to take the smallest size of the position possible and call that one tranche. This makes it as granular as possible in order to size the position up or down based on all the variables. Now next, are there any setup or execution drawbacks? Does the system trade options that are illiquid, for example, that would cause slippage? Does the system require legging in, which would cause directional risk just to get in and out of the trade? I also like to look at the time requirements. So if I have to be in front of my computer all day, then that's a major drawback. And these are the considerations I have in mind while evaluating these trade structures. Now, Kirk says he uses the VIX hedge in his portfolio to curve some of the tail risk of his positions. He says he does not think it will eliminate all risk to the downside, and he believes that is not possible. Now the idea is increasing the freedom to add more risk to his portfolio and therefore increase his returns. So basically adding more income structures because he is able to better protect those structures from the downside. His strategy has two components or two different strategies. One is to protect against short-term volatility strikes, and the second component is a doomsday hedge to protect against large volatility moves. Now, large volatility, he defined it as VIX being higher than 50. The goal is long volatility exposure with a low cost. Now, Kirk has two separate hedge structures, the VIX Doomsday Hedge and the VIX Ladder Bull Spread. Now, the VIX Doomsday Hedge is pretty simple. It involves buying VIX calls at the 10 delta at 120 days till expiration. And when time goes by and the 120 days turns into 90, you put on another tranche at 120 days till expiration. And it's like a laddering effect. And you continue this until you have 4 tranches on, and then you maintain 4 tranches as time goes by. You spend about 0.25%, not 25%, 0.25% of your account value per tranche, which works out to be around 3% per year in costs. See his video for more details. Remember, there's a link in the description. And I'll look at how to determine the results of this type of hedge since 2008 later in this video. The second hedge, which is the VIX Ladder Bull Spread, is similar in terms of laddering based on 120 DTE, days till expiration, then adding a tranche every 30 days, and eventually maintaining 4 tranches as time goes by. And this method shorts one call contract at the 80 delta to finance 2 further out calls, and you do it all for a credit. Then it looks to take part of the trade off at the potential cost of the actual trade and hold the long single VIX call for a crash. So the cost of this hedge is also 0.25% of the portfolio per tranche, but that's only max risk, not a hard cost. And again, see details in Kirk's videos, and you'll also see details as I backtest this later in the video. And some notes on Kirk's hedges. The Doomsday Hedge is the one available for most people as they can use the strategy with a small or large account. This strategy allocates 0.25% per month to buy VIX calls at the 10 delta when the VIX is relatively low, like it was in 2019 before the 2020 crash. Kirk was able to put this on the VIX strike at around 40. Now, the question is, when would he sell it? And how much protection did that create? And most important, how often did it work? And after going through a few videos on the subject after the March 2020 crash, I was able to get a more defined trade strategy from Kirk. During the 2020 crash, he sold the VIX Doomsday Hedge when the VIX got to 50. Selling at 50 provided about a 1-to-1 hedge for his portfolio, meaning that if his portfolio was down $10,000, then the hedge made him about $10,000. Basically, how the Doomsday Hedge worked in real time was that it hedged his portfolio to break even, which was the purpose. Knowing this, my next question is, how many crashes or significant grind downs occurred since 2008? And I use 2008 because that's how far I normally backtest, and that's where I have all my data in OptionNet Explorer. And then, of those crashes, how many times did the method protect the portfolio? Portfolio protection can be defined as, number 1, you got to be in the trade, and number 2, when the VIX broke 50. If the VIX did not break 50, then the hedge was not used. The VIX Ladder Bull Spread strategy won't be used as much because Kirk recommends a $300,000 minimum account size to use one tranche of this strategy. In order to put on the lowest one tranche in his backtest, it took around $700 to $800 in risk, which amounts to about 0.25% of capital per month. His goal is not to spend or risk more than 0.25 of its capital per month on a hedge. And this makes the strategy unrealistic for a lot of people. With that said, I'll get into some more research on these two hedges right now. Okay, so the first thing I want to do is see, how many crashes occurred since 2008. This is 2008, definitely a crash here. Now you have these two spikes, one in 2010, one in 2011. Now the thing is, my particular priming selling system wasn't really affected negatively in these two situations. I'm pretty sure though his was, because his is a lot more straightforward and linear. So when it comes to these two, you could call those a crash scenario for his type portfolio. I would not call it a crash for my portfolio because I back tested this area and it wasn't. But because we're talking about his portfolio right now, we'll add these in. So we've got 2008, 2010, and 2011. Then you've got 2015 in August. You got 2018 in February. And you also have this grind down here that I'm going to add because this significantly affected a lot of option sellers' portfolios. It did go up to 35, but didn't have a super spike like a crash. It was a grind down, but it did have an effect on my portfolio, and I'm sure it had effect on Kirk's portfolio because the market went down 20%. And then we had, of course, the March crash. So right there, that's 2008, 2010, 11, 15, 18, twice, and 2020. So that would be 1, 2, 3, 4, 5, 6, 7 crashes. And remember, his Doomsday, it only capitalizes on a crash when the VIX is over 50, because that's when he sells out. Okay, so in 2008, he capitalized and broke even. Here, the VIX went to, the VIX went to 48. So he did not sell out. So he did not, his VIX didn't, his hedge did not work here. So that's a no. 2011, you can see that it peaked out at 48. It didn't hit 50, so his hedge did not work there in 2011. And 2015, 52. I'm going to say yes, he got out in 2015, that hedge protected his portfolio. 2018, right at 50.17. So I'm going to have to give him the benefit of the doubt, even though I doubt that he would have got out perfectly, but it did go over 50 for a split second there. So let's say that he got protection. Then the grind down of 2018, no, he did not get protected there. Took some losses. And 2020, of course, yes. So of the 7 crashes, 1, 2, 3, 4 of them, he broke even. Okay, that means 3 of them he did not. Now, when you take into effect the cost of this Doomsday Hedge from 2008 to present, so that means that he had this hedge on for 14 years. And remember, the numbers are 0.25% per month because he's laddering in every month, which comes out to 3% per year. So he spent 3% 14 times. So in essence, he spent 42% on his hedge, which worked 4 times out of 7. So 3 times his account got wrecked pretty good, and he still spent 42% on this Doomsday Hedge. For me personally, I would not want to spend 3% a year in order to get protected 4 times out of 7 crashes, but that's one way to do it. And I just wanted to run the numbers so you could take a look at what he's talking about with this particular hedge that he uses on with his portfolio. Next, I'm going to get into the spread, and this one's a lot more detailed, and I'm going to do some back testing with it. Okay, so now I'm going to take a look at his spread hedge on the VIX, and let's do this through the 2020 crash. It's kind of best case scenario, I would call it, and it's where I have the best data. Let's start this here. Now, remember that he starts 4 months in advance and ladders in. So let's go with if we go 4 months before March, say we start on December 1st, December, January, February, March. Let's start on November 1st, 2019. Just to make sure we got it all lined in there. Everything will be in. So we'll start this day here. Now remember, we need a $300,000 portfolio. That's a pretty big drawback to this particular hedge, but anyways, so we're going to go to about 120 days. We have to pick one of these. I'm going to go to 110, and then once this gets to 90, then we'll put another one on. That's how we did it. So we're talking about calls, not puts. And he said to start at the 80 delta and go short. So here's 83. So I'm going to go short, -1. And then I want to buy 2 of these and do it to where I don't have a debit. So I'm going to go 1 here and 1 here. Let's take a look here. Just kind of a starting point. Okay, so I have a debit here because I can see it. So I'm too close. Try that. No. Okay, so that's about as close as I'm going to get. Putting this on. And I'm actually over the sea of death when I place this trade. So it's kind of difficult to put this particular one on at this particular time. I mean, that's the best I can do. Maybe I'll move this up here. Oh, this is closer to 80 anyways. Yeah. Okay, let's do that. Okay. Okay, so do we want to pay a debit of, 25 bucks? Or do we want a credit of 75? Well, I'm just going to make sure we have a credit, so I'm going to go with this. This is the best I think we can do. We're going to commit this trade. I'll just call this 1. I don't care what name I give it. All right, now we want to go take this to 90 DTE. It's about 30 days from now. Go back. Okay, so now it's at 90. Now we're going to put, because that has time, we're going to go ahead and come in. Oh, 120, 118, that's good. So now we're going to do this again. VIX at delta at 80. That's pretty low. Let's see. Oh, 11. Okay, no, that's not too bad. Okay, so we got -1, and let's try these 2. Put this on as a new trade. Okay, still a debit. Why? How do I know this? Well, because there's the break even, and here's the expiration line. So here you go. You have it for a swipe credit here, 50 bucks. Got your max risk at only $450. So maybe you can do this with a $150,000 portfolio right now. Because when the VIX is lower, this is affected. So the VIX is pretty low at this time, 13.5, I guess. But so let's go ahead and put this on, because we're going to take this into the crash. Let's take this right here to 90 days. That's another 30 days from now, approximately. There it is, okay. So now that's at 90. We'll go back in and do this again. 80 delta is a 10 -1. Let's go up here. Let's see what we have. And we're up, see, I'm looking over here, 84 bucks. I might be able to, well, I don't know. Let's see. You know, that's only 20 bucks. I'm already over the sea of death here. It seems like if I'm starting over the sea of death, it seems like I'm doing something wrong. But he said to start at the 80 delta and go short. And well, that's got to be positive. let's commit that. Okay, and the reason why I'm over the sea of death is because when I look back at where Kirk was doing this, the VIX was around 15 or 16. That was the value of it, and so when he put it on, he wasn't above the sea of death. But it looks like when the VIX is really lower, a little bit lower, like around 12, you're going to start over the sea of death with this system. I don't really like that too much. Okay, so where were we here? We were here. We just put this on, so we're going to take this to 90 days. It's April 15th. It's about another month away. Right there. That's 90 days. So we'll go to this one, 125. We're going to be getting close to, well, we're getting closer to the crash here. Let's see. Let's go to, there's 78. That's about as low as we can get. Look at that. The VIX is, you know, around 12. Let's go -1 and buy those two longs. And that's 119. That's probably a little high. Let's see if we can get this. Yeah, there we go. That's actually kind of pretty good. I mean, you're still, you know, positive, 35 bucks. And unfortunately, you're starting over the sea of death because that's the way the system is when you go short here at the 80. All right, so let's go ahead and commit this trade. And let's move this to 90. Let's see where we're at. Probably another month out or so. Okay, now it's at 90. Let's take a look at the next cycle. 118. Get down to the 80. That's a 10. -1. Okay. That's a little high. 107. Let's see if we can lower that. Lower that lower expiration line. There, that's good. See how we're right there at break even. That's where we want to be. Way over the sea of death, right at the middle of the sea of death. Okay. There's the next trade. Well, we're going to go back and look at all these and how they perform through the crash. Let's take a look at. Let's move this one now to 90 days and put on our next one. There it is, 90 days. So this is the one we put on. Everything's 9999. There, okay. And now, all right. So our 80 delta is going to be at the 75 strike. I know that Kirk would not put on this spread with his short at 75. So let's go ahead and take a look at the results of these trades. Well, it's March 19th. March 18th is when he actually, well, when the VIX was at 50. It's, you know, now I kind of have to guess a little bit about, well, when did he take these things off, right? Or when did they pay for themselves? That's one of the main things that I want to know is, you know, when was he able to buy these things, or I should say sell the spread, and that would pay for the risk in the trade, and then have the leftover long all by itself. I hope that makes sense. So let's go back. Here's the crash. We're say March 19th. That's a good time to say we're definitely in a crash. So let's go to this particular trade and let's go back Let's take it back before the crash. Let's go right here. Now, the question here is, on this particular trade, when was this spread, this 10-16 spread, worth, you know, $400 or better? Because when it was, that's the way this, you know, is looked to be managed. It looks to be managed. Take your risk off when you get a chance and hold your extra long and let that thing go. So let's just see when this thing starts making some money, and then we can kind of run the calculations. All right, it's making a little bit of money. Okay, there's a major point I want to make here, and that is when you're dealing with the VIX, you're really dealing with the VIX futures, and when you're dealing with the futures, it's different than dealing with like SPX or SPY or Apple. And you can see that in the reflection of the profit right here is only $84, but it should be on this line, this expiration line, at a minimum at $550. It's taking into account different expiration cycles, and so it doesn't stay with this line, with this expiration line, like it should. So you would expect this to already be paying you that $500, but it's not. And why did I say 500? Because that's what we're trying to get in order to break even and then hold that extra long. So it's definitely got to be over $500, because then we want to hold this long on top of that. Okay, there's 389. There's $500, but that's for the whole trade. I'm not going to take the whole thing off. I've got to be better than that in order to have this extra long right here, which is worth, what, $9? What, $900? I'll just take a look at it. Let's see when we can get up in there, high enough to where I can take a piece of it off. Well, you know, I'm just going to take a look at this. If I took this off, so it looks like I would get, if I'm correct here, it looks like I'd get about $495 if I took this off right now. So it needs to be, you know, around $1,500. So let's just say that Kirk said, hey, now's the time to take off this spread so I can hold this extra long right here. Okay, because he's been looking for an opportunity to get this spread paid for, but just to make sure that, you know, if vol contracts, which it normally does, he at least got out with some money, or broke, you know, he broke even at a minimum. Okay, so let's do this. So now he's sitting there holding this one long right here. All right, now let's look at the other trades that are on. Let's see if they're doing the same kind of thing. Okay, this one right here, he could have broke even probably earlier. No, around that same time. Right about here. So let's take this off. Now we have this free long, right? Let's go into, I already did this one, let's do this one now. Okay, so we know we haven't hit that $1,500 mark, so where we can get it free long. There it is, okay. So I like this concept, you know, of being able to pay for your hedge. That's one of the goals that I would always have. Let's just go ahead and take that off. So we have this extra long right here. And this last one, let's see when that possibility occurred. Nah, probably not. Let's try to see if that does it. 13. See what that's worth. 385. Let's take it off. Okay, so now we're left with these longs. This one might fall off. Let's watch this one. Let's see what it's worth. So where are we? So when are we going to take these off? Well, this one has 5 days left. Let's just call March 19th the big day when there's a big crash. Okay, well this one fell off right here on this last day, so we're going to take it off. Held it till expiration and then got paid with the cash that it was worth. We'll go back and analyze all these trades. And let's start with this one. This is at 89 days. Let's just go to March 19th and take it off, whatever it's worth. And we'll just take all these off. This is probably giving him the benefit of the doubt that he held until March 19th to take all these off. But, you know, you just don't know. Let's just do it. And there. Now we'll go to the reports. Take a look at this. Okay. So it looks like we made about let's call it $19,000, which is, you know, that's a good profit. Obviously you made money. You took them off when you took the spread portion off when it paid for the risk of the trade, and then you held the extra long and you held it until a serious crash moment, and you made about 19 grand. I don't think that protects a $300,000 portfolio very well. And I think the reason behind it is because of this futures aspect of things, where you don't get the full benefit of what you think you're getting. The VIX might be at 50. Let me just talk about this in terms of term structure. Okay, if you look at the term structure, you see you're dealing with, the VIX might be at, you know, 66 or 70 or whatever, but you're dealing in these different expiration cycles where the VIX is only 42. The VIX is only 50 in this one. The VIX is only 58. It's not 68 or 70, because you're dealing in these different expiration cycles. They don't all correlate with what the VIX spot price is at that moment. The VIX spot price is way up here, but you're dealing in these guys. And see, and that's why you're not getting that full explosion with this particular hedge. And I don't know if I hope that makes sense, but that was one of the drawbacks that I saw with this particular hedge. And you can see that what happened, it only made $19,000 on a $300,000 portfolio. So this particular ladder bull spread hedge is not really as effective as it might seem on the surface when you backtest it. Also, if you're interested in the backtest software I used, I'll leave a link in the description of how I use the software, and 10% discount if you want to go ahead and use it. Next, I'm going to go over what I like and dislike about each hedge. So what I like about the Doomsday Hedge is that it can be used in pretty much any size account. The risk of the trade itself is zero because you're buying options. It does not eat up margin. The setup and execution is easy and straightforward. It does not take a lot of time to put on the trade, maybe 10 minutes every 30 days. And as far as when it is activated, it does provide enough protection. What I don't like about the Doomsday Hedge, what I don't like is the amount of protection for the cost. Also, in 7 events where the protection was required, it protected 4 times. That leaves 3 points in time since 2008 where the hedge did not protect the portfolio. This protection is not enough to increase risk or increase sizing in your portfolio, I believe, because the hedge will not save you. It is just not statistically effective enough in terms of occurrences. Another big negative is that you cannot put this trade on during or after a crash. You need to wait until volatility comes back down, which took around 8 to 10 months after the 2020 crash. Now, a hedge is supposed to be always on, protecting the portfolio, but with this trade, you can have gaps in protection. The most important variable is value. Do the costs outweigh the benefits? The cost is about 3% per year, and it only worked 4 times in 14 years. I think the costs are greater than the benefits. I would not do this with my portfolio. Now here I've broken down, so you can see, the cost of the hedge per year. So 2008 it made a profit, 09 minus 3%, 10, 3% loss, 2011, 3, 2012, 13, 14, all 3% losses. 2015 it made a profit, and 16 another loss, 17 had a loss. 2018 it had a profit in the beginning, and then it had a loss towards the end of the year. And 2019 down 3%, and of course 2020 it was profitable. Now next I'll get into what I like and dislike about the ladder bull spread hedge. I like that the trade itself does not carry any risk. The margin requirements are very low. The trade setup and execution is straightforward and easy. It does not take much time to execute, 10 minutes every 30 days. Now my dislikes. The amount of protection is not enough. The risk graph looks good, but when the trade is actually executed, the protection is way less than advertised because you're dealing with futures contracts. And this trade also comes with the same big negative as the Doomsday Hedge. You cannot put this trade on during or after the crash. You need to wait until volatility comes back down, which took 7 months for Kirk to reestablish the trade in his portfolio, leaving his portfolio unhedged for 7 months after the crash. The capital outlay is about 3% per year, but the trade will more than likely cost much less, probably closer to 1% in my best educated guess. But that is too high for the protection that was given. The cost of the trade structure vastly outweighed the reward, in my opinion. When portfolio positions are highly correlated to the VIX, they take high losses when the VIX is high. When the different VIX expiration cycles are used as a hedge, the pricing within those expirations can be low even when the VIX is high, because they are based on what they will be priced at in the future. This means the VIX can be high, causing your short premium position drawdowns to be high, while your hedge is based on a low number and the protection will be low. Next, I'll get into hedge number 3. After backtesting the VIX bull ladder spread, ideas started popping into my head about how I could create a hedge that could be partially taken off in order to pay for itself and then still have some hedging ability left over. Now I looked at 4 or 5 ideas using SPX rather than the VIX. I wanted to avoid the futures drag on the hedging power. And looking at the SPX, I came up with an idea that combined a lot of my past trading knowledge combined with my experience on certain trade structures. I tested each of them in a crash, and I found one trade in particular that I liked. I then backtested that trade through all the crashes, and it performed well. The next thing I did was backtest it from 2008 to present to see what the overall cost, drawdown, potential margin required, and planned capital required was. And answering these questions would help me size the trade effectively and see if it could provide a good amount of hedging protection in terms of value. And I do like what I see. And nobody else knows about this hedge or specific trade structure, and nobody else is trading and managing this trade. I developed specific rules after backtesting the structure. I call this hedge structure and the trade plan around it the Domm hedge. It is brand new. I developed it in early April 2021, and I've executed the trade with real money And I'm very confident in this hedge, and I will be holding the Domm hedge in my portfolio from now on. And now I'm going to go over, kind of show you the personality of this hedge, and then I'm going to compare it to the other two hedges that I just went over. Okay, let's get into the personality of the Domm hedge. I'm in the Analysis tab, and you can see here, starting in 2008, basically this is all just kind of starting with zero money, and by the end of, what was this, a couple of months ago, I think I went all the way into 2021, at about $22,000 overall. That's interesting that the hedge just, obviously made money over time. But you can see here, 2008, you can see it, the equity curve here just go up. And then 2009, 10, 11, 12, 13, 14, 15, didn't significantly move. I mean, this might be $500 or something. And this is a hedge that would protect approximately about $8,000. This is what you're going to see with protecting about $8,000. This is one tranche. So this might be a $300 drawdown or something like that. And here might be another $400. It's not significant, but you can see that when there's a crash, it makes money. When there's nothing going on, there's no crashes, it's not losing money. 2015 crash, boom, then nothing happened. Now this trade is always on, similar to Kirk's trade there, he always has it on. And here you can see from after the crash of 2015, it was put on. And by the way, it was put on right after the crash and during the crash, and it works fine. You don't have to wait until the volatility or the VIX goes down. You can just keep it on all the time, even in the middle of the crash. And you can see here how it just broke even, made a little bit of money until 2018. Boom, February 2018. Now, one drawback, the grind down of 2018. This is down around $2,000. So you've got, I'm going to say, I haven't really done the hard numbers yet. I got to do a little more research on the planned capital because this is kind of early in the development. But this is a $2,000 hit because of a grind down situation where the market went down 20%. So this does not protect against grind downs. But grind downs, only one significant grind down occurred in the last 14 years. But when there's a crash, look at this, here's a 2020 crash. This is just really nice because why did this keep going more and more and more compared to these other crashes? Well, because the crash continued to go more and more and more, and you can keep this hedge on, and then when you take profits, say you took profits right here, well, you put another one on and it makes profits. Take profits, put another one on. You can put it on in the middle of the crash. You're not going to lose money on it. So you can see that it actually did well after the crash even, because the volatility was coming down after the crash, and it does well in that environment. Obviously, you can see. So the aspect of the personality of the trade is, in a environment where the volatility is falling, it actually makes money also. But the main thing it does here, as you can see, is it doesn't cost anything, and then boom, when the crash hits, you make money. Now the drawdowns with the Domm hedge were minor, less than 4% of planned capital, except for 2018 grind down where it went down 13%. That was a loss. Now you can allocate a set amount of capital in reserve, and it is like keeping some of your portfolio in cash, except it pays when the market crashes, and it has a worst case scenario of having to be replenished of 13% only once in a 14-year time frame. So I can set aside a fixed amount of cash and protect my portfolio for many years rather than experiencing a hedge as an ongoing cost. Now next I will compare the three hedges that I have just gone over. Okay, so now looking at the comparison, the first thing I'm going to do is ask the question, so how much protections do you get with the Doomsday it's good. When it's activated, it works. With a VIX ladder bull spread, it's low. You don't get the protection you think you're going to get. And the Domm hedge, of course, the protection is good there. How much does it cost? Well, the Doomsday is 3% a year. The ladder bull spread, 1%. And the Domm hedge doesn't cost anything. What are the risks of the trade itself? Well, the Doomsday has no risk. The VIX ladder bull spread, none. And the Domm hedge does have that rare circumstance where there's some risk, like in the grind down. What are the margin requirements? With the Doomsday, low. VIX ladder bull spread, low. And with the Domm hedge, the margin requirement is, I would call it a medium. Are there any setup or execution drawbacks? And that's no for all three. All three are very executable and easy to set up. What are the time requirements? About 10 minutes a month for each one. So, they're all equal there. And are there gaps in protection? And of course, with the VIX Doomsday, yes, you'll go unprotected. With the VIX ladder bull spread, yes, you will go unprotected. But with the Domm hedge, you're never unprotected. You always have that hedge on, and it'll pay off if there's a crash. Now, looking at the performance by year, you can see 2008 Doomsday made money. The VIX ladder bull spread, it was under hedged. It didn't make the amount of money it should have. The Domm hedge made 14% on planned capital. 2009 minus 3% Doomsday, minus 1% on the ladder bull spread. The Domm hedge actually made 3%. 2010 Doomsday minus 3%. VIX ladder bull spread. It under hedged. I guess there was a situation where a hedge was required there. It under hedged, and the Domm hedge broke even that year. 2011, the Doomsday lost 3%. The VIX ladder bull spread was under hedged, and the Domm hedge made 2%, a 2% return. And 2012, Doomsday minus 3, VIX ladder bull spread minus 1.5, and the Domm hedge actually was down 2%, but it recovers. But it's not like a take it loss and then that money is gone forever. You're still in the trade. You're just down 2% for the year. Then in 2013, Doomsday minus 3, VIX ladder bull spread minus 1%, Domm hedge broke even. 2014, Doomsday minus 3%, VIX ladder bull spread minus 1%. And again, Domm hedge was down 2%, but it wasn't like a loss. It just recovered from there. Now, 2015, the Doomsday profited, covered the losses in the account. The VIX ladder spread under hedged. It paid some money, but not enough. And the Domm hedge had 24% returned on planned capital. So that'll help you figure out, how much you need to hedge your portfolio. 2016, Doomsday minus 3. VIX ladder bull spread minus 1%. Domm hedge was actually up 1% that year. 2017, Doomsday down 3%. VIX ladder bull spread down 1%. Domm hedge up 3%. 2018, the Doomsday had a profit in the beginning of the year on the crash, and then it had a loss on the grind down. The VIX ladder bull spread, it was under hedged during the crash early 18, and then it was down 1% during the grind down in 2018. The Domm hedge for that year, of course, it was up on the crash and down on the grind down, but it actually returned 15% on planned capital that year. 2019, you had that kind of a normal year where Doomsday was down 3%, the VIX ladder bull spread down 1%, and the Domm hedge actually was up 2% that year. And then 2020, the Doomsday paid off well, but then after that, there was no hedge for 8 to 10 months. So you went naked, basically. And then the VIX ladder bull spread, again, when the crash occurred, you didn't really get that payout that you would expect. You were under hedged, and then you were no hedged, naked for 7 months. With the Domm hedge, you made 83% on planned capital, and then you were hedged from then on after the crash. So that just gives you an idea of a comparison of the three hedges. So an analogy would be purchasing a car in 2008 that will go 0 to 60 miles per hour in 3 seconds. You never know when you're going to get into a race, so you always drive it around just in case. With the Doomsday and ladder bull spread hedges, the car is depreciating every year, and you need to add new parts to it every year. Also, right after you race it, it requires service for many months before it can be ready to race again. So there's a problem because you're not driving it around and you're hoping you don't get into a situation where you need to be in a race. With the Domm hedge, the car is always ready to race, even right after a race. And the car runs just as good in 2021 as it did brand new in 2008 because it does not depreciate. Now, I'm not sure what I'm going to do with this new trade. Honestly, I think it's so good, I'm not sure if I just want to keep it to myself. Or maybe create a course and sell it. Or maybe contact a few hedge funds and see how valuable it would be for them. If they could hedge their portfolio by basically allocating capital one time and let it be used over and over until a crash comes, I think they would be interested. This is like allocating capital that does not draw down, like cash in the account. It's like an opportunistic trade that acts like a reactive hedge. But it's not a reactive hedge, it's a proactive hedge. And you don't need vol spikes or a crash for the trade to break even. So, I'll just ask you, just comment in the comment section what you would do with this information if you had it. And hey, if you're interested in my free options proprietary trading course, I left a link in the description below. And you can sign up for the course there. And hey, don't forget to hit that like button on the way out. Thanks.